Meanwhile, there was some welcome news on the exports front. Non-oil domestic exports for February came in better than expected, rising a sharp 30% year-on-year. However, experts say it's too soon to celebrate. External headwinds from Europe and rising oil prices still pose risks to sustained growth. Yvonne Chan reports.
The latest exports data surprised many analysts on the upside. Compared to the 2.4% decline in the previous month, the sharp lift in February's non-oil domestic exports of 30.5% was the strongest showing since October 2010. The surge was due mainly to non-electronic exports climbing 34%, with exports of specialized vessels and oil rigs soaring 94% on-year. Meanwhile, pharmaceutical exports also added 45% on-year to hit a record $2.4 billion, the largest ever for Singapore. Electronic exports also jumped 23% to $5 billion, buoyed by higher demand for PC parts. And it seems the notoriously sluggish tech sector could finally be on the mend.
There could be some bottoming out based on the poor electronic cycle we have seen in the last 12 months. That could be one of the factors. US data looks better than expected. That could be one of the key support coming in for the next few months.
But some experts say they're not surprised by this rebound and they do not expect a repeat performance in March.
We had expected, after the contraction in January, a rebound in February, mainly because of the base effect. The shift in the Chinese New Year festivities this year to January versus February last year basically has played havoc in terms of working days and factory being closed. We probably will see March NODX pulling back very sharply. Typically, after a very sharp spike in export.
The numbers for February may have exceeded expectations, but going forward, analysts say it's too soon to presume that the upward trend can be sustained due to the continuing uncertainty in the Eurozone and rising oil prices, which could pull back global demand.